Good afternoon and welcome to HFI's Year-End Planning Strategies webinar. I am Chris Dorsey and I run the Investment Analysis and Portfolio Strategy here at HFI. Today's presenter is Amanda Runkles. Amanda joined HFI about 4.5 years ago. She is a CPA and a CFP, and she is also a Senior Wealth Manager and the Director of Financial Planning here at HFI. In today's webinar, Amanda will be presenting some useful and important information on year-end financial planning strategies, and she will also discuss some important changes to Social Security claiming strategies. And while Amanda is a CPA as well as a financial planner, HFI does not practice as CPAs, we practice as financial planners. Questions are always welcome, and if you have any that arise during or after the presentation, please feel free to contact us via phone or email, and we'll be happy to provide some additional insight. We will have our contact information on a slide at the end of the presentation for you to jot down if you do not already have it. And this information is also posted on our website, www.hfiwealth.com. And today's webinar will also be posted on our website. So thank you again for joining us today. And without further ado, I will hand it off to Amanda.
Thank you, Chris. And hello to everybody. Thank you for taking time out of your afternoon to join me today to talk about some year-end planning strategies and the updates to Social Security. I know secretly you are tuning in today so that you have something really exciting to talk about at your holiday parties. Nonetheless, this is actually really important information, and so we'll go ahead and get started. Specifically for those who have attended my webinars in the past, you'll probably recognize a lot of the tax information that I'm going to go over. The good news is that there's no new tax changes to plan around, so we know what to expect and we know how to plan around them. But nonetheless, the first part of this presentation is a bit of a repeat from what I've talked about in years past. So let's just talk about an overview of the most widely publicized new taxes that are out there. So there's really two legislation acts that impose these taxes, the Affordable Care Act and the American Taxpayer Relief Act. The Affordable Care Act imposed two taxes, the 0.9% tax on earnings, and so those are earnings like wages and salary. And then there's the 3.8% surtax on net investment income, so those are imposed against interest and dividends, capital gains, rental income, etc. And then the American Taxpayer Relief Act, there's a few different tax changes under that. The first are the PEP and PEAS limitations, and those are against itemized deductions and personal exemptions. They become limited once your income exceeds certain thresholds. There's the inclusion of a higher marginal tax bracket, the 39.6% bracket, and then there's the 20% tax on capital gains and dividends. That's increased from 15% if your income exceeds certain thresholds. So I'm not going to go into a bunch of details on how the taxes are calculated. I have done webinars in the past on those, and if you wish to recall those, they're on our website. We record all of our webinars and post them on our website for viewing on demand. So a lot of the year-end webinars have just touched upon how these are calculated and specific examples. So I would recommend revisiting those if you are interested in, getting some really good sleep at night. So anyways, all right, so let's look at the thresholds that you have for single and married filing jointly. So I have the different taxes here on the left, and then the thresholds for income for each of them. So the Affordable Care Act taxes, the 0.9% and the 3.8% surtaxes, those come into play when your income exceeds $200,000 or $250,000. The limitations to itemized deductions and personal exemptions start hitting you when your income is $250,000 or $300,000. And then the higher marginal tax bracket and then the higher capital gains rate start to affect you when your income's $400,000 to $450,000. So several of these income numbers are actually indexed for inflation. So the real numbers may be a little bit larger than this, but it's just difficult to conceptualize those numbers when they increase by a few percentage points each year. So, but I use the base numbers here because then it's easier to remember what the limits are, and you can determine whether you're approaching that limit. So what I like to recommend is that our clients do what's called a tax projection, whether it's yourself or whether you get together with your tax preparer or CPA. This is a really neat thing to do, and it's a really important thing to do. So you want to map out what your income is going to look like for the next 5 to 10 years, and then determine which of those taxes are going to affect you in any of those given years. And that's really the first step to plan how to prevent or reduce your impact to those taxes. So some possible variations or assumptions to include in your forecast would be salary increases, Social Security or pension income, becoming age 70 and a half and taking your RMDs, or if you have rental properties and you plan to sell them, certainly that's a high income that's going to be included in any given year. So I've prepared, once you do that for a 5 to 10 year period, you're going to go back and compare to this chart. I'd be happy to print this and provide it for anyone that's interested. And let's look at an example that I prepared. This is for a married couple over a 5-year time period. You can see that we've looked at different things that are going to happen each year. So in 2015, they just had their salary. Their salary and their total income falls below any of the thresholds. So there's nothing extraordinary to plan for here. In 2016, they expect to get a really big bonus. And so their income is going to exceed the Affordable Care Act thresholds, and so they're going to be subject to these new taxes in 2016. In 2017, they plan to sell a piece of property, and so their income exceeds not only the ACA thresholds, but it also crosses over into where their itemized deductions and personal exemptions will be limited. In 2018, they plan to retire and start drawing a pension and Social Security. So their income drops again, but they still may be subjected to these ACA taxes. And then in 2019, they turn 70 and a half, and they're going to have significant RMDs to consider. So now they're butting up against, again, over the threshold for the ACA taxes and the itemized deduction and personal exemption limitations. So this is really important to do, to look at these, to determine which taxes will affect you. Once you know what taxes you'll be subjected to in any given year, you want to take a look at different strategies to reduce your income so that you don't have to pay as much into those taxes. So this is a really great chart that I created last year. And again, I'd be happy to print this and provide it for anyone that's interested. We have the different taxes here at the top, and then there are different strategies here on the horizontal axis. If there's a star, then that means that strategy will help reduce the tax associated with it. So we're going to talk a little bit more in detail about what each of these taxes, more details about how you can reduce them. We're going to go into that in another slide. But again, this would be a good chart to have if you think through your projection you'll be subjected to any of these. So let's take a look at each of these strategies a little bit more in detail. To the extent that you know you need to reduce your net investment income, these are different ways that you may be able to do that. Rental real estate is actually taxed at the 3.8% level. What rental real estate provides, though, is generally a cash inflow that's offset by depreciation expense. So it's generally an inflow that's sheltered because of the different expenses that are associated with them. There's oil and gas investments are a possibility. Charitable planning may be an option. So if you have a dividend-producing portfolio or some dividend-producing stocks that you don't need for retirement planning, it may make sense to gift those out to a charity. Not only will you receive the charitable deduction, but you will also get these income-producing assets off of your books, so you won't have to pay income on the dividends. Capital loss harvesting is a really cool strategy that we're going to talk about, and actually that falls within several of these categories. Capital loss harvesting is a strategy where you can sell investments that have an unrealized loss associated with them, and use those losses to offset capital gains that you've taken earlier in the year. So remember, capital gains are taxed at the 3.8% tax level, So if you harvest losses to offset those gains, you have less net gain to be imposed against the 3.8% surtax. So there's some wash sale rules that you have to be careful of, and we're going to talk a little bit more about that in a few slides. But capital loss harvesting is a really important thing to do. We've been implementing that in specific situations for our clients for a couple years now. So it's a really cool thing to do. Municipal bonds provide tax-free income, and tax-deferred annuities in some situations will reduce net investment income. If you need to reduce your adjusted gross income, a few options would be to increase your contributions to retirement plans or IRA accounts. Roth strategies actually don't provide an immediate benefit, but that's where that projection really comes in handy, because if you know a few years down the road your income needs are going to be greater, you might want to have a Roth bucket set up so you can take money out tax-free. So in order to get money in those Roth accounts, you may want to increase your contributions now or do Roth conversions. Those can get pretty tricky, so you definitely want to see a professional about those. Capital loss harvesting is also an option here. You can bank capital losses and just keep them in the bank and use them later on down the road. And then you also have the option to use other vehicles like tax-exempt bonds and annuity or life insurance products. So you see here at the bottom that I've crossed out the option to make your RMD directly to a charity. So the story behind this is that for years and years and years, there's been a rule that you can direct your RMD to go directly from your IRA to a charity. And what that does is it almost acts as if you never got the RMD in the first place. It's never even reported as income. Generally, for the past few years, Congress waits until the end of December to pass that rule for that given year. And so what that does is it's too late at that point for you to actually implement that strategy. You can still do it. You can direct your RMD to go directly to a charity, but the problem is that you take the risk that Congress isn't going to pass that law towards the end of the year. So that's just a risk you assume at that point. Okay, if you want to increase your above-the-line deductions, you can do things like maximize your contributions to retirement plans. I put the limits in here. So the limits are $18,000 if you're under age 50 or $24,000 if you're over age 50. And those limits didn't change for 2016. You can also maximize your IRA contributions. Again, $5,500 if you're under 50 or $6,500 if you're above 50. You can also contribute to health savings accounts. Some rules for itemized deductions or some ideas for itemized deductions. In some situations, you may want to reduce these deductions, and in some situations, you may want to increase these deductions. So to the extent you want to reduce the deductions, some ideas may be to refinance or pay down your mortgage, which will reduce the amount of deductible interest you have. Contributing to a 529 college savings account actually reduces your state taxes, but your state taxes flow over to your federal tax return as a deduction. So if your state taxes are less, then you get less of a deduction on your federal tax return. To the extent you want to increase your itemized deductions, you can front-end load your medical bills or make charitable contributions. Either of those may help increase your itemized deductions. Okay, so a few other ideas that you may have is if you fall in the lower two tax brackets, so the 10 or 15% marginal tax brackets, you actually have a 0% capital gain tax. So you can actually take advantage of something called capital gain harvesting, which is a really cool idea. There's no rules against selling an asset at a gain and then repurchasing it the next day. So you could sell assets, capture the taxable gains, rebuy them the next day, and what this accomplishes is basically getting a step up in basis without paying taxes on any of it. So that's a really cool strategy to use. Capital loss harvesting we've touched upon. What you need to be careful of there is the wash sale rule. It's very complicated. In a nutshell, basically what it means is that you can't buy that security 30 days before or 30 days after when you do the capital loss harvesting. So it gets fairly complicated, so you definitely want to enlist a professional to help you with that. Another idea is to gift income producing assets outside of your household. So you can give away $14,000 a year to each person. If you and your spouse wish to gift split, you can give $28,000 a year to another individual. Okay, so it's not too late to implement some of these before the end of 2015. A few things you might want to consider: capital gain or capital loss harvesting, charitable donations, 529 college savings account contributions, front-end loading your medical bills, or giving income-producing assets away out of your estate. Again, you can see here that I marked out the R&D directly to a charity. Again, you can do that. There's nothing to say you can't. It's just not necessarily approved yet that it'll work as a tax deduction. So that's a risk. And by April of 2016, you still have time to make your IRA contributions for 2015. So that wraps up the basic principles that I wanted to talk about from a tax standpoint. I'm happy to answer any questions you have. And again, this is a recap of some items that we've talked about in previous years. But I want to jump over and start talking about Social Security. So about a month ago, Congress passed and the President signed the Bipartisan Budget Act. And within the act, it changed some loopholes in Social Security. And we're going to talk about those because they actually affect a lot of people. So let's talk about the basics of Social Security before I start talking about the changes. So at a basic level, you're eligible to claim Social Security in one of two ways. You can claim it on your own earnings record or your earnings record of your spouse. Up until recently, you had the option to choose whatever is best for you. So the most popular rule used to be what was called the file and suspend and restricted application strategy. Doing so in application was that the higher earning and older spouse at full retirement age would file and suspend their benefits, and then their spouse was able to file what was called a restricted application and receive spousal benefits only. So the spouse was able to get half of the higher earning spouse's benefit, while the higher earning spouse was able to delay their benefit and capture an 8% annual increase until they were 70. And in some situations, that increased their benefit by 40%. So that was a really big deal. It was huge. It was a great strategy to implement. Well, a hot topic over the last few years is that clearly there's questions about whether there's solvency in the Social Security trust over the long term. And so it was pretty clear that something needed to be done to save that. So what they accomplished through this Bipartisan Budget Act was taking this loophole away. So the new rule says you can still file and suspend, but what happens is if you suspend your benefit, you suspend your benefit of anyone drawing on your record. So you're still allowed to do it. You can still suspend and get an 8% increase per year, but nobody else is able to draw off of your record while you're suspending. That's what they took away in a nutshell. So if you still want to suspend, you can still earn delayed credits, but your spouse can't get the restricted application when you do that. So that's a huge deal. It's a really big, really big deal. There's a few people that are grandfathered in. If you've already begun a file and suspend strategy, you're fine. Nothing changes. And that was actually not the way the law was originally written. The law was originally written that everybody was affected by that, even if you'd started claiming that way. And so luckily they changed that at the last minute and took that out so you could be grandfathered, and that would have been so significant. It would have just had a major impact. Nonetheless, they did grandfather those people in. Now, if you were born before May 1st of 1950, so if you will be 66 by May of 2016, you can still implement a file and suspend strategy. So you have to turn 66 before May of 16. You can still do this. The catch is you have to do it by May of 2016 or you'll never have the opportunity. So there's a really short time horizon here for us to accomplish this. If, however, you were born after May 1st of 1950, you will never have the opportunity to file and suspend. That's being taken away. So the translation is that there's a 6-month window for anyone that will be 66 by May that they can still file and suspend. So remember, voluntary suspension can be done at full retirement age, but if you implement that after May of 16, you will suspend all your benefits being paid on your record. So the second half of this is to address what happened to the spouse filing a restricted application. So this is what the deemed filing rule does. So prior to all of these changes, the deemed filing rule said that when you came in at full retirement age, you could choose which benefit you were applying for, your spouse's or your own. You could choose, remember. But if you filed before full retirement age, you were deemed to be filing for all your benefits. So you were penalized for filing early. Well, they changed that. So now the deemed filing is extended to age 70. The translation is anytime you go in at any age in any application you file, you will be deemed to be filing for all of your benefits. You do not have the opportunity to choose which benefit you're filing for. So that's how they took away the restricted application piece of this. But again, there's some grandfathering provisions. If you reach age 62 before December of this year, December 31st, you will be grandfathered in. In other words, you will still have the ability to file a restricted application for spousal benefits only. However, if you turn 62 after January 1st of 16, you will never have that opportunity. I hate being the bearer of bad news. Trust me, I don't like this any more than any of you listening in, but that's the way that it works. So, in a nutshell, how this works, if you are 66 by May 1st of 16, you can file and suspend. And if you're 62 by 12/31 of this year, you can file a restricted application for spousal benefits. Those are the two magic ages that get grandfathered in. I want to stop quickly and point out this May 1st date. The legislation is actually written to say May of 2016. It doesn't actually give a date. We're assuming May 1st, but it may not be May 1st. It may be May 31st. It may be May 15th. They haven't really come out with any guidance on that yet. So if you're watching this and you were born May 14th of 1950, don't get discouraged quite yet because there's no guidance yet on what the exact date is. The big takeaway that you need to remember from this is that you have to do this by May of 2016. If you do it any later than that, you're not going to be eligible. So it's really important that you talk to your advisor, get some recommendations, have a Social Security update done for your household, talk to your friends. There's going to be a lot of people affected by this and they're not going to see it coming. And if they wait until May or June of 2016, it's going to be too late. Okay, so there's a few other changes. Retroactive benefits. The old rule was that you could backdate your application 6 months and receive a lump sum payment. The new rule is that they're not going to let you do that anymore. And then lastly, the widower and divorced spouse benefits. So there's nothing in the legislation that mentions widower benefits. So as far as we know, the strategies remain unchanged. However, for divorced spouses, they may have suffered an unintended consequence. Since the rules for restricted application are short-lived, divorcees may not be able to file for a divorced spouse benefit and switch to their own later. So that's going to get very, very complicated. But remember, if you reach age 62 before 12/31, you can still file a restricted application. Very important to talk to your advisor about all of this. It's very complicated. And we're happy to update your Social Security analysis. We've done a lot of these for our clients over the years, and because this is so new, they really need to be updated. So again, if you are 66 by May or 62 by the end of this year, we need to talk about this very quickly to see if you need to make any changes to your strategy. If you don't get grandfathered in, we still need to address this because it could have an effect on how your retirement plan works and the cash flow works over the long term. So I would definitely advise calling in, ask me questions, let's get together and talk. Again, tell your friends about these rule changes. The last thing that we want is to see people not expecting this and be caught off guard when they go to retire. Here's my contact information. Please get a hold of me. I'm going to wrap this up by thanking you all for coming today. We work closely with your CPAs, so please talk to them, talk to us. We love working together for the benefit of you. Again, I'll reiterate that we are not tax preparers, so we do work in conjunction with your CPA. Look forward to seeing you again in January or February of 2016 for Chris Dorsey's kickoff webinar, where he'll address the financial markets. And I would like to end this by wishing you all a happy holiday, and we hope to hear from you soon. Take care.